Good morning. My name is Tim Nyland, and Managing Director of Professional Services here at Zacks. And today is July 15th, and this is our internal strategy call. I wanted to go ahead and start out with an analysis of our tilts, specifically the valuation of the recommended tilts for not only the earnings certain family of portfolios, but for really any core equity portfolio. And it seems as though in watching CNBC and even listening to the news and reading the Wall Street Journal that a lot of people have caught up with the strategy that we've recommended obviously earlier in the year, which is more or less exposure to the top 5 S&P names, and then obviously adding in Adobe. And so, they're saying that this trade has become overcrowded. Bank of America came out with a research note on it. And so this morning, I actually whipped up some charts and did some additional analysis, and I'm really struggling with the overcrowded generalization or characterization of the Bank of America commentary, to be specific. I don't think that this trade is overheated or overcrowded, and there are very specific reasons why the smart money has moved into this particular area. And specifically, it can be generalized as not an overheated trade, but it's reflective of where the growth is. It's a growth trade. And I've mentioned on numerous webinars that I've done that growth rarely goes out of style. And certainly when we're in this sort of challenged, volatile, environment, clearly have never been here before, that growth would be, again, favored over value. We saw another value rotation attempt late day Monday. It looks like we're giving it another shot now. I haven't seen the market here in the past 30 or 40 minutes, so I'm not sure exactly what's going on. But at any rate, it does appear as though value is giving it another shot at a rotation, but I don't expect it to last too long. What you'll see in looking at this 10-year chart of a price to F2 earnings. So again, there's a lot of different ways to look at PEs. And we're using the Zacks research system to do this analysis right now. So under charts, valuation histories, you'll see that we literally have just a myriad of PE multiples. I would disregard the use of GAAP earnings. We have them here for a very specific reason, none of which I would ever use for actually doing real life valuation work. We always do our earnings in terms of valuation work with the adjusted earnings or the before non-recurring item earnings. Strips out all the one-time non-recurring events, accounting anomalies, that sort of thing, gives you a clean earnings stream. So your PE trailing, your F12, your F1, F2, I like to go out as far as possible to remove that earnings trough that we're currently in. And F2 is going to be the longest range series we have. But even if you were to do an F1 or a 12, you're still going to get a very, very similar view. So you can see that in aggregate, we're using the composite facility here in ZRS to aggregate the 6 tilt holdings into its own single stock, if you will, or composite. And that ticker symbol is the ZEC, or Zacks Earnings Certain Tilt Portfolio Equal Weighted. And you can see the name up here. And you can see that on an F12M basis, it's roughly 2x in terms of valuation. On a forward 12, if we bring this to the more preferred metric at this point would be the PEF2, you can still see that we're trading at around a little bit more than 2x. So S&P 500 is about 20, and the collective tilt basket is about 43. Interestingly enough, it's not really of much use to look at PE ratios in an absolute basis. Even trying to compare a PE ratio relative to its own history can be very dangerous because PE ratios move for one of two reasons, right? They either move because there's been some sort of underlying company event or they expand and contract due to changes in expectations for macroeconomic headline risk. And we quantify that in terms of equity risk premium. Obviously, with regard to each individual company's fundamentals, that gets rolled in as well. So it's always a combination of the two. So in order to remove the macroeconomic headline risk component from any PE, you have to do it relative to something. So it's one thing to say, well, wow, this looks expensive, right? Bank of America says this is a heated trade. Why? Well, the PE ratio has gone from 31 to 43 collectively for the top 6 names. I'm going to say the top 6. Adobe's not quite a top 6 name, but if it keeps going the way it is, it will be. And the S&P 500 has, definitely gone up as well, but nowhere near as this group. You can't really do that, right? Because we're not taking into account equity risk premium, among other things. So we have to basically convert this to a relative series. And when you do that, you'll see that we're really not that overheated. We're a little bit hot, currently at 2.12 times the S&P, right? This is a relative. And its median is still a 1.92, and the high is actually 2.29. So we were actually more overheated throughout pretty much all of 2018, and I didn't really hear Bank of America screaming about it then. So I'm not really sure I'm buying into it now. However, I will give them the benefit of the doubt because we haven't really completed our analysis, but I'm urging caution here in trying to say, blanket statement that this group is overheated. I'm not really seeing that. And we can take the analysis a step further by breaking this down into its component members. And again, things can look pretty deceptive if you're looking at this stuff on an absolute basis, right? So here you can say, and it's interesting, I made the Apple 5G call and talked about the ecosystem at Apple. I've been a holder of Apple for a long time, but really, really backed up the truck on Apple here in around the March timeframe at the lows. Massive 5G opportunity, and everybody that made that transition. I know we've got employees on the call now that made some really strategic tilts that have paid off nicely. But this is a PE on price expansion for sure. This multiple has expanded really, really aggressively. But again, if you look at this on a relative basis, yeah, it's a little bit hot relative to median. But certainly we could take this back further in time and see that Apple's been here before. So a little bit aggressive, not too bad. If we look at Adobe, same thing, right? 2.3, nothing like the 368 that it was in 13-14, below a 0.93. Keep in mind that these technology business models have also evolved and are rapidly changing. If you take a look at Adobe and Microsoft specifically, you'll see very, very specific trends. I think this is even more evident in Microsoft. Yeah. So back in 2016, you can see the PE ratio for Microsoft just literally pulling away from the broader market, whereas it actually trailed and was pretty much even against the S&P from 14, 15, 16. And this is really where they got aggressive into the cloud technology and really started, moving really rapidly on their enterprise pricing model, their subscription model, I should say, for the enterprise software. So anyway, you got to take a look at this stuff on a relative basis. Again, we're at 144. We've been as high as 194. Median's 0.99, a little bit hot. But again, overheated, overcrowded, I'm not sure. Google has always been here, right? We're at a 1.35, median's 137. I don't really see any issues there. Facebook, this thing just keeps getting cheaper. Really don't see an issue with Facebook. 1.2, the median's 188. Again, we're in pretty decent shape. Amazon, interesting case here. If we take out the earnings trough period, you can see that this looks really, really cheap right now. It's probably not as cheap. We got to get rid of this trough period back here, where they had a trough in earnings. So I'd like to bump that down to about a 3-year time frame. and you can see that we're right at median. And I know that sounds insane because Amazon has just gone parabolic. But again, I'm just not seeing this overheated, overcrowded theory that others are really jumping on the bandwagon about. So if we did have to come up with some sort of reasoning or some sort of logic behind, why these stocks have traded at such premiums for such a long time, the answer to that question would probably be best answered by just looking at some of the earnings growth that this group has experienced. So I put together an interactive chart this morning. I know Meyer likes to use some different flavors of this. And what I'm doing is I'm just keeping this at a 10-year time frame. And that just coincides with the PE analysis that we've just done. But when you think in terms of fundamentally driven PE multiple expansion, so removing the macroeconomic forecast component out of this thing, I applied the tilts personally to my own portfolios back here in 2013, 2014, before these earnings for these top 5 names just absolutely went parabolic. But we're actually looking at adjusted EPS or operating EPS growth over the last 10 years. And you can see the earnings certain portfolio in aggregate obviously outperforming the S&P 500, but the tilt group has just absolutely crushed them all in terms of EPS growth. And so this is obviously the lifeblood of what's behind the PE multiple expansion that we see underway with these top names. And if you look at the EPS growth from here to here, it's a pretty good indication of why those multiples have expanded. So I don't think that investors are crowding into this space just for the sake of crowding into it. It's where the growth is at, and it's also where the growth is going to be for quite some time. And I think that investors are now finally catching up to this idea that, hey, I probably need exposure to this group, and we've obviously been exposed for quite some time, which has been to our benefit. So we can actually quantify this a little bit more aggressively by taking a look at how profitable these companies really are relative to their underlying capital structure, as well as their underlying ability to generate cash flow. Because those two fundamental type ratios, if you will, or return ratios, are probably the two most important determinants of whether this sort of PE multiple expansion, this excuse for, if you will, an overcrowded trade would actually be warranted. So if I were to look at some return on capital and some free cash flow return on investment, I would hope to see that, this group in aggregate would be significantly outperforming the S&P 500. And obviously, we have those charts in the Zacks research system. We also have them in advisor tools, and I think I might have showed a couple iterations of this last week, but I do want to show it in the research system as well. They're going to be actually located under the fundamental history and under the return on capital. And we've got a lot of different metrics in here. I've got a couple favorites. I just like the return on capital specifically. And you can see that, if we're going to trade at a PE that's over 2x, we would expect return on capital to be well in excess of the S&P 500 as well, and it is. So if we were trading at a 2.1 relative to the S&P 500, we're basically generating 2.34 times the return on capital over the S&P 500. So is that really a surprise? It shouldn't necessarily be. And again, I can click the plus button here and literally go through each individual stock. But you'll see that, Apple just continues to rise. It's going to continue to rise. There's really no better run company in the world. I mean, these guys have built the ecosystem, and the 5G thing is just getting started. 350 million iPhones are going to be upgraded within the next year out of the 900 plus million that are out there. It's just insanity. One of my favorite names that I warned everyone back in March that you're not going to hear much about Adobe, but you will, and certainly we're hearing more and more about Adobe now, hitting new highs every day. A little under pressure this week, but it'll be fine. But almost 3x return on capital. These guys are just absolutely firing on all cylinders. They're one of the highest actually. Amazon obviously making a lot of investment here. Bringing down that return on capital, but it'll bounce back. Facebook looking nice at about a 2x. Google, solid as well. Microsoft over 2x. Again, it definitely warrants a multiple expansion well in excess of the S&P 500. So, and I would say that valuations for these top 6 names, I wouldn't say it's overcrowded. I would say that they're probably fairly valued, and I would say that valuations have probably just caught up to where they probably should be based on the amount of return that these companies in aggregate are generating. It's absolutely spectacular. The next thing I want to talk about was the fact that I was able to finish the Q2 rebalance, if you will, or the analysis of all of the equity select lists. So started with the standard industrial proxy, went through SICK, went through GROW, then hit the earnings certain portfolio, went through the earnings certain portfolio, went through the Admiral, went through the dividend aristocrat portfolio. And in accordance with keeping the turnover low and not having any knee-jerk reactions, keep in mind that 40% of the S&P 500 companies have cut guidance, and I've decided not to make any changes to any of the earnings certain portfolio family of model portfolios this quarter, and I've got a lot of the companies on watch, and I just want to kind of review some of these things with everyone today. So I'm going to go ahead and throw the earnings certain portfolio up here, and you'll see that obviously the return on capital for the overall earnings certain portfolio is roughly 50% higher than the S&P 500. This again reconfirming that theory that the earnings certain stocks themselves always trade at a premium, and you'll see that they do, and this is obviously the reason, including the free cash flow return on investment. Still roughly 50%. It's huge. But let's go ahead and take a look at our price and earnings chart. Definitely my favorite kind of home base view, and I did have the time frame abbreviated when we were looking at Amazon, so I'll bring this out to 20, 25 years. 20 years is probably all we need. But this is the earnings certain portfolio in aggregate. You can see this. I'm calling it a one-time shift, if you will, in earnings. We can deal with something like this once. I obviously don't want to see it happen again. But obviously we've got the Admiral portfolio that more or less addresses that. This is the group of stocks that's expected to do a better job of moving through this particular recession, of the shutdown of the entire U.S. economy in much better shape. So the idea is the Admiral portfolio is a 30 stock portfolio, and the earnings certain portfolio where I get this dip in earnings is a 75 stock portfolio. So there are, if you just subtract the two, roughly 45 of the names that I've more or less put on a proxy watch, if you will. These are the names that I'm watching very, very closely to ensure that their earnings get back on track, and I don't want their earnings to get back on track with some completely different business model, and that's really what I'm looking for. So if their business model changes significantly, that would be a cause for removal from the earnings certain portfolio. Keep in mind that these businesses, these companies that are in here, they've got to be able to maintain their current operations and have 20 plus years worth of history. So we like solid, long-standing business models that have proven to be successful. And so there's a few names in here. Let's go back to the earnings certain 75 stock. I just wanted to kind of go through. And I've had some questions on some of these. Obviously, I've done the analysis. I've been through all these names. The first one I want to start out, just kind of show, generally speaking, what I'm referring to. Starbucks is moving forward very aggressively on a slight tweak, I'm calling it, to their business model. And I know I mentioned this in a couple of our webinars prior, but they're moving very aggressively to their to-go model and away from their in-store dining. This is something that they came to the conclusion based on their own study of their receipts that roughly 80% of their business, their revenue has been driven by to-go orders. So I applaud Starbucks for doing this. I do expect them to resume this arrow straight line. So I'm comfortable keeping a name like this in there for the time being. I want to make sure that this really does happen, and that we see this resumption in profitability. So this is potentially a really nice opportunity if we get this vaccine story and it sticks. The one that we got this morning, breaking news. Look for Starbucks to just to really start taking off. This is one of those recovery names, if you will. And then, similarly speaking, we've got McDonald's in here. You're going to see, a similar, although not as aggressive, but a similar type trough here in McDonald's. Same sort of thing. And this is what I'm referring to about, not making any knee-jerk, changes at this point. You've got a lot of these companies that have cut guidance, and if I start removing one or two, then what's the justification for not, completely slicing and dicing the whole group up and really not knowing what's going to happen to these business models and where these earnings are going to fall? It's just prudent at this point to kind of take it as a wait and see. So, you can call these names value at this point. You can call them broken growth, however you want to classify them. They are a reopening story, and we've got roughly 45 reopening stories in the earnings certain portfolio. So the names that I have on watch would be the difference between the 75 stock portfolio and the 30 stock Aristocrat portfolio. So I should say the Admiral portfolio. The Aristocrat's the dividend. Another one that I wanted to briefly mention that is, where is it? Raytheon. This is obviously a defense name. It made its emergence into the earnings certain portfolio from the merger with Raytheon and United Technologies. Northrop Grumman is another one. It's interesting to see the difference between Raytheon and Northrop. Tickers, I can't remember what the ticker is. NOC. So NOC, you could argue to be an earnings certain name as well. Will I end up swapping these two names out? Maybe. I want to see what's happening with Raytheon first. Again, guidance cuts. Will that earnings stream continue is the question, and what's going to happen to Northrop? Northrop has, their largest growth segment is being driven by, a top secret project that they're not even allowed to report on. I think it's like 25 to 30% of their revenue growth coming from that. So we don't really have much visibility into Northrop as well. So one interesting thing about earnings certain names that collapse like this, and I've been through this. I've been doing this for, over 25 years now with this portfolio. When you see these types of collapses, and obviously we're talking about earnings growth rates resuming at a similar, if not even a more aggressive rate, and even stable from 2021 and 22, we're looking at 18% growth. There's interesting opportunities at these levels to start dabbling in option strategies, and they can be very, very profitable and very enhancing to portfolio returns over time if done correctly. And so I'm going to be talking a little bit about option strategies. I've been active in the options markets for 20 plus years, and had some real success stories and some real tragedies along the way that I can share with everybody. But in regards to Raytheon, at this point, either taking a nice long position and even buying call options would be a good idea as we start to see this stock begin to turn on this sort of a recovery. And certainly once we get through earnings season, we get a little bit more visibility as to how this most recent quarter came in. We'll know more about Raytheon, but this is probably one of the larger collapses in the earnings certain portfolio. But it's also one of the larger opportunities. And I've actually made a trade of call options yesterday, and that was July 14th. This is my actual account. And I wanted to just take a look and start seeing what the decay factor was relative to price appreciation that Raytheon might actually experience here. And so I bought at the money calls yesterday for a 61.50 strike. So I'm actually in the money today, and I'm already up 151% in one day. You can see that there. I only bought one contract, so I'm starting to now dabble with this name on the option side, and essentially, we'll deploy leverage now to amplify the returns, because if I, having done this before, I know that when Raytheon rebounds, it's going to rebound hard and fast. It's an earnings certain name. It's obviously well watched, well liked, well covered. And I want to be ready on that name with some leverage. So what I'm doing here with one contract is just getting an idea for at the money, near expiration calls, whether or not a change, how the option contracts themselves are going to behave relative to a change in the underlying price of the asset relative to the time decay. I've only got 2 days until this option contract expires. It expires on July 17th. So there's risk there of my option going to basically zero because of time decay. The only reason I'm up 151% is because my options actually went in the money. So I paid 70 cents and they last priced at $1.41. I'm in the money now, so every single penny or every single dollar that Raytheon goes up from here is basically 1 for 1. And so every dollar it goes up, I'm basically going to tack on another 100% or so in profit. Okay, so it's probably going to be more like 130% in profit. So I want to start educating everyone on these types of option strategies. Over the years, they've been really, really instrumental in providing a pretty significant alpha for my portfolios, and I'll show you guys how to implement them as well. So at any rate, I've got a really good understanding now, obviously, of watching this over the last day of how this behaves. So I'll be ready when Raytheon makes a move, and I'll be doing this for obviously other earnings certain stocks as well. So at any rate, that's all I really wanted to discuss with everyone today. Rest assured, I'm watching the earnings certain stocks, and I think it's just at this point very prudent not to make any changes. And we know these companies have rock solid return on capital. We know these are the cream of the cream in their industries, and I think it's just prudent to wait a quarter at least and see how these earnings come in. So thank you all for attending, and we'll talk again next week.